Oikein paljon tervetuloa Aktian webinaariin. Tänään käydään läpi vähän mitä markkinamahdollisuuksia on tarjolla pääomasijoitusten jälkimarkkinoilla. Ja vähän taustaa ensin aiheeseen, että miksi tämmöinen tuodaan tarjolle tässä nykytilanteessa. Pitää mennä pikkasen historiaan. Jos me ajatellaan vaikka viimeistä 15-20 vuotta, meillä on ollut korot todella alhaalla. On ollut nollakorkoympäristö. Tämä on osaltaan ajanut sijoittajia hakemaan vaihtoehtoja, ehkä vähän riskinkin kustannuksella erilaisista sijoituslajeista. Ja erilaiset listaamattomat sijoituskohteet, rahan keruu näihin on ollut tosi voimakasta, pääomat on kasvanut ja nyt ympäristö on muuttunut. Eli nyt keskuspankit on nostanut ohjauskorkoja, korkotasot on relevantilla tasolla, tarkoittaa, että sijoitusmarkkina on demokratisoitunut tietyllä tavalla. Sijoittajalla on mahdollisuuksia enemmän kuin aikaisemmin. Tämä on pääomasijoitusmarkkinoilla johtanut siihen, että myös isommat toimijat niin alkaa olla tosi paljon niin kuin sijoitettuna jo rahaa. Ja koska rahaa halutaan aina palauttaa myös sijoittajille, niin yhä enemmän yritetään ehkä myydä pääomarasta kohteita jälkimarkkinoilla toimiville sijoittajille. Ja tämä on avannut paljon mahdollisuuksia sen kaltaisille toimijoille. Ja sen takia me ollaan nyt tässä. Okay, short intro in English. Today we're presenting possibilities in the secondary markets for private equity investments. And we have our specialists from UBS collaborating with us, telling us about the interesting possibility. We have Eric Carroll, which is responsible for UBS Nordics. And we have the leading portfolio manager, Johan Mende, which is a deep down expert in the area of secondary private equity investment. Maybe to get things started, just a really overall question about private equity. The most common thought is that it's reserved for really the high-end institutions. Tickets are big, the investment periods are long. How do you feel about this, Johan?
Well, first of all, thanks a lot for having me and for organizing this webinar, and thanks for everybody for participating. Now, historically, it is true private equity was only accessible, only investable by investors with large portfolios, long investment horizons that could write $5 million plus checks and build portfolios with, tens of or hundreds of millions of US dollars of investable capital. But now, with the advent of open-ended evergreen fund structures like the one that we are going to present today, investors of all stripes can actually participate and get exposure to private equity with as little as 50,000 euros.
Thank you also, Samu, for the invitation to be here, and good to meet everybody on the phone. A question from my side. There are very different ways to access private equity. So why do you think, Jochen, the way that we are proposing to invest in the asset class is the right one?
Yeah. So if you think about how to invest in private equity, you fundamentally have three ways of doing it. Either you invest in companies directly yourself. That is very labor intensive, that is very capital intensive. Or you hire a fund manager to do it for you. In order to get to an appropriate amount of diversification, you need to hire multiple fund managers. And that is also not coming without its challenges. You have a capital call model, you have long investment periods, takes you a long time to build a portfolio up. Reporting requirements are, quite demanding for some investors. And then you have a multi-manager investment approach where you hire somebody like a UBS Asset Management to build a private equity portfolio for you. That has a number of advantages. One is you have multiple underlying fund managers that invest the capital on your behalf. You have the overlay of UBS Asset Management that provides the fund selection, the manager selection, and reporting and all of this. And if you wrap this multi-manager approach into a product like a secondaries-focused product, you get the added benefits of quick diversification, capital is at work quickly, It's very easy to own. You don't have to deal with capital calls or distributions. And you get underlying fund manager diversification. So you're not beholden to, the fates and fortunes of one investment house. You have multiple investment houses underneath. Yeah.
Now you have already mentioned one, secondaries. So before we go into the presentation, perhaps you can define and explain exactly what a secondary is?
Sure. So if I've convinced you now that, perhaps investing in companies directly is not a good idea if you don't have the skill set, but you should invest in private equity funds, preferably we think in multi-manager funds. There's multiple ways of doing it. Shall we say, the one that requires the most patience and skill set from investors is you participate in private equity funds at the start, so you're primaries investor. If you're a secondaries investor, you find somebody that wants to sell their private equity funds and you buy them from them. And so how to define secondaries? It's essentially the acquisition of private equity assets that somebody owns in privately negotiated transactions. And that strategy has several benefits. For one, you get, again, your capital to work quite quickly. You get diversification very quickly, and you get manager diversification very quickly as well, as opposed to, writing commitments to private equity funds who then have typically 5 years' time to call that capital from investors and build a portfolio.
How about, Johan, the term evergreen? It sounds like summer is just ongoing and never goes away. What does it mean in the private equity context?
So your normal private equity fund has an official lifetime of 10 years plus extensions. So it is closed end. This fund is not. This is a portfolio that will continuously invest into private equity secondaries. This is a fund that has an open-ended lifetime, and the evergreen structure just ensures that we are constantly reinvesting, rejuvenating the portfolio, so to speak.
Okay, interesting. So yes, if there's, we can follow up with questions ongoing, but maybe if Johan can show us a few slides on the actual product.
Sure. Let's perhaps start with a quick slide on why private equity. Why should I bother as an investor with private equity? Well, fundamentally, private equity investing gives you access to companies you cannot access on the public markets in its simplest form. Yeah, that includes very early stage companies, that includes small and mid-sized companies, anything that is not quoted on any stock exchange. The asset class tends to outperform public market investing over longer periods of time. There's large debates in the literature, in the industry about what that outperformance is driven by and how high that outperformance really is. As a rule of thumb, over longer periods of time, you should expect an excess performance of anywhere from 300 to 500 basis points over public market investing. And because of the way how private equity reports returns, this outperformance should come at lower volatility than what you typically expect or what you typically see in the public markets. So these three factors alone, plus the added benefit of having fund managers that are taking significant influence or exerting significant influence on the underlying exposures, in our view, gives you exposure that is a must-have for every investor's portfolio, in our opinion. Now, there's various ways of doing it, of accomplishing this exposure. We've touched upon those just before. So either you participate in private equity funds from the start, so you're a primaries investor, or you find yourself somebody who, for whatever reason, wants to sell their private equity exposure and then you buy into these assets, and then you are a secondaries investor. As a rule of thumb, typically it takes anywhere from 3 to 5 years for a private equity fund that is being formed to show up on the secondary market again.
May I ask a question there? So, why would an investor sell private equity to you? And sort of, is there not a risk that you are only buying what the original investor don't want?
So, the reason why people sell their assets on the private equity secondaries market evolve over time are not always connected to asset quality.
Okay.
Yeah. So think regulatory changes, think changes in personnel, think changes in the portfolio strategy or portfolio construction constraints. At the moment, what we are seeing is lots of investors, because of what has happened over the last 2 years, simply have a cash flow problem that they need to solve. Their private equity portfolios are calling a lot more cash than they give back. And perhaps their reserve allocation has not been appropriate. So there's always lots of good reasons why people use the private equity secondary market to create liquidity. And again, it does not always have to do with asset quality. As far as that is concerned, it's our job as UBS Asset Management to filter out where the bad assets are and make sure that we are not buying just the lemons that people want to get rid of.
How do you, Johan, actually, when you do the secondary transaction, how do you come up with the price for the transaction, since there's not that liquid benchmarks going around like in grocery stores?
Yeah. So we look at the underlying asset base and try to understand what the final outturn for a given portfolio, for a given fund, for a given company investment could be. In order to do that, of course, you need to understand the business models of these companies that you invest in. You need to understand the strategies of the funds that you are buying and the strengths and weaknesses of the managers that manage these funds on your behalf. So I'm being supported by an entire team of private equity experts that sit around the globe. All we do is focus on private equity investing, and we've been doing this since 2000. So we've seen a thing or two, and we know who can drive value, who is good at what. And we take all of this information together to then determine a price for any given asset that we want to buy. And there are assets that we wouldn't want to buy at any price, to be clear. Yeah.
So the pricing is always, you make your own independent analytical opinion of it, and then approach with that the counterpart.
Exactly. Yeah, if you look at the market, I mean, there's always price data that is being published by the intermediaries. I should say one fundamental thing people need to understand about the secondary market is these are privately negotiated transactions. Intermediation, so brokering of these transactions, is becoming more and more prevalent. We estimate that about 80 to 85% of all deals are intermediated. And these intermediaries publish pricing data on a semi-annual basis. You see it on this slide here on the right-hand side of the chart. So according to this particular intermediary, you could buy a private equity buyout fund at a high teens sort of discount to reported net asset value on average across the universe. Now, with these averages, I mean, you need to understand what is the distribution underlying this average. And I can tell you at the moment, given the market, you can buy old private equity funds for 30, 40% discounts to net asset values. The question there is, however, what is your return driven by? Is it driven by just buying assets cheap and hoping nothing goes wrong? Or is it more driven by, and that's what we focus on, buying quality assets that have room to grow, that have a story to tell at discounts to the reported net asset values from the fund managers. Perhaps spending a little bit of time on the market and the market opportunity. If you look at this slide on the left-hand side, what you see is how assets under management in private equity have grown. And what you note in particular is this really astonishing growth since 2017. Now keep in mind something that I said earlier. It takes about 3 to 5 years for any private equity fund to be available on the secondary market for us to purchase. So we expect a further dramatic growth of secondary transaction volumes in the next couple of years. The only limiting factor for the secondary market as it stands today is the availability of capital. 2009, the secondary market was tiny, only 10 billion of transaction volume overall. This year, we are estimating that it has grown to 130 billion plus. Some estimates say the market this year will be 150 billion, we'll see. But if you take that estimated transaction volume in relationship to the amount of capital that is available for these types of transactions, you get to a ratio of about $1.3 available in terms of investable capital to expected transaction volumes, which in comparison to other private market strategies is actually the lowest. So I'm expecting this dynamic of being able to acquire quality assets on one side at discount to net asset values to stay around for a little while with us.
If I understood correctly, you buy assets that are 3, 4, 5 years old. So what would be the benefits of doing that vis-a-vis being a primary investor in the market?
Think of this analogy here on the left side. If you compare the styles of investing in primaries and buying secondaries to placing a bet on the outcome of a race, if you place your bet halfway through, you just don't have to wait for the outcome of the race to manifest itself so long. So in other words, our holding periods of assets that we acquire on the secondary market are shortened already by 3 to 5 years.
Gotcha, okay.
So we get capital back quicker. We also get to see how the underlying portfolios have performed or how the underlying assets have performed since they've been invested by the original investor. So there's a certain element of risk reduction inherent in the strategy because I get to see what I'm buying as opposed to investing in a primary where you sign up essentially for a blind pool of capital. You have no idea what's going to end up in that portfolio eventually. Also, your capital is just at work much quicker in a more diversified way, in a risk-reduced way, as if you like. Yeah. So we think secondaries and secondary investment-focused strategies. I mean, I'm obviously biased, being responsible for this product and our secondary transaction activities, but they have a place in every portfolio. In particular, if you're just starting out with private markets investing, secondaries is the way to go.
It seems that, as you mentioned, the growth of the market, there's ample opportunities, and it seems like it's a buyer's market. So you have the luxury of being really selective, of being selective. How many deals do you on average look at before you decide to invest in one?
So we see on an annualized basis 600 to 700 deals a year, and we do 10 to 14. So there's a lot that goes out of the funnel very early on, either because the opportunity is not the right fit, it's too large, it's too small, we don't like the assets, we don't like the fund manager, we don't like the pricing expectation that we're being told, we don't think there's any upside left in the assets. So, yeah.
It's interesting.
I would say it's quite a stringent selection process, if you know what I mean.
Yeah.
Are there any particular sectors that you focus on, or are you a completely generalist?
Well, if you think about private equity as an asset class, what is typically invested in. There are certain sectors that just fall out because they're not well suited for private equity investing. So anything that is capital intensive, think heavy industries, for example, banks. Yeah. Then there is an overlay with our ESG policy. The fund that we're in the market with is an SFDR 6 fund. Plus UBS's ESG policy excludes certain sectors, so coal mining, nuclear power plants, that sort of thing. And then we as a team have a preference for investing in healthcare, investing in tech-enabled business models, investing in some subsectors of financial services. So I wouldn't describe us as a sector specialist. I also would not say that we are generalists. Yeah. We have a preference for certain sectors that work really well within private equity.
Yeah.
When we think about the investment strategy a little bit further and our view of the secondary market. So what this product will do is it will give investors access to a globally diversified portfolio of private equity assets that we intend to build via secondary transactions. We'll also complement that secondary allocation with select co-investments. And we are transaction type agnostic. So what the fund will do is we will be able to, and we will buy fund interests from willing investors that want to sell. At the moment, what we see there is it is a buyer's market. We get assets that are of very good quality at, discounts to net asset value. In some cases, very steep discounts to net asset value. And we have a certain amount of purchasing power. In that segment, we'll focus on deals that are below $100 million worth of transaction volume. Why? Because in our view, it's the most attractive segment for us to invest capital. Yeah, the competition from the larger funds is lower. The intermediation in that segment is lower. The sellers are more open to having discussions around transaction structures and pricing because the competition for deals is just not as intense as it is in other segments of the market. We will complement these so-called LP-led transactions by transactions that are initiated by a fund manager, the type of situation where a fund manager has a company that they could sell but don't want to sell in the current market environment because either they can't get the price that they want to accomplish, or because they simply see an opportunity to drive further value in the underlying companies over an extended holding period and over or with incremental capital. What we see there at the moment is that these types of transactions are orchestrated by very reputable fund managers and often involve very good companies and very good assets. And very often the fund managers themselves are providing significant amount of capital to effectuate these deals, so there's good alignment of interest there. And we will complement these two with opportunistic transactions. Preferred equity deals is one element that we're looking at actively, but also spin-out transactions and secondary directs. What all of these three elements have in common is our focus on fund manager quality and on asset quality and on valuation.
How would you say on this growth period for the fund and strategy, which of the three segments has been the most driving the purchases?
Yeah. So we've started and activated that fund in November of 22. So for the last 2 years, we focused our time and attention a lot on this middle segment, the GP-led transactions, simply because we thought these deals were extremely attractive from a risk-return perspective. Also, we had some question marks about the robustness of valuations of LP portfolios. We've now shifted our stance more towards the LP-led side of things as our confidence in valuation robustness has improved. And we'll go back and forth between those two. Opportunistic, as the name says, will mix into the portfolio. In fact, we're working on one transaction right now that qualifies as an opportunistic transaction. It's a preferred equity deal, but really LP-led transactions and GP-led transactions are going to be the focus of the fund. Going forward, perhaps more balanced than it has been in the last 2 years.
Jochen, I'm happy to say that we also have a question from the audience. So do you plan to ever sell your position prior to the end of the fund's life? Is that something that you could consider?
We could consider that, and we would consider that if we are not convinced that any further upside in the underlying assets deserves holding on to. So the fund, because it is an evergreen fund, has the ability to actively manage the portfolio in that way. And then whatever proceeds we would get out of a sale like that, we would reinvest in new transactions and new deals. Yeah.
Thank you.
Good. Thank you for the question.
Keep them coming.
Please keep them coming, yes. So for whatever reason, my clicker doesn't work anymore. Can we go to the next slide, please? Okay. Oh, here we are. Yeah, so coming to the fund is available via Aktia. We think it hits a couple of very important points that should make it very easy for investors to invest. We spoke a lot about the focus on secondary transactions. 75% plus of the capital will be invested in these types of deals. I explained the focus on why small LP deals also. We will provide exposure to small and medium-sized enterprises that otherwise are not available to investors. The fund, again, is very easy to own because it is fully paid in. So all of the capital that investors provide us with on the subscription date is being called right away, and then we take care of the investment and the reinvestment on investors' behalf. It is semi-liquid, so we offer quarterly liquidity to investors subject to certain restrictions, which we'll talk about in a moment. And it is available with very low minimum investments. Yeah, you can participate in the fund's portfolio with as little as 50,000 euros. Compare that to the 5 million that I had mentioned earlier that were typically required and necessary to participate in a private equity fund. And again, it's very comfortable to own. We publish NAV on a monthly basis. You get quarterly liquidity, and the whole management of the product is essentially in our hands, and you don't have to worry about it as an end investor. The fund, as it stands today, is at 142 million euros of assets under management. Of that, about 87 million have been actively invested. Keep that number in mind. In 19 transactions as of today that are managed by 16 managers and will provide access to over 100 companies. Performance so far, you see that in the middle column here, a 26.8% gross IRR. The portfolio is valued at an average gain of 17% for a gross TVPI of 1.17. And again, the portfolio offers exposure to 19 investments. The next subscription into the master fund is at the end of September. Aktia requires a little bit of time to pass that on, so the next subscription date is the 27th of September.
Yes, that's true. 27th of September is the cutoff time, 10 o'clock finish time, but obviously we take subscriptions ongoing all the time.
Okay, good. Looking at the terms of the fund real quick, what are we trying to accomplish? So we target a net IRR for end investors of 12%. Over an investment cycle. We suggest an investor that comes into the fund now stays in for 3 to 4 years. The fund is available in euros, in Swiss francs, and in US dollars. The fund's lifetime is open-ended, so it's an evergreen fund, as we mentioned earlier. That means that the investment period is also evergreen, so the portfolio is constantly rejuvenate itself with new transactions that come in. We offer up to 5% of the fund's NAV as liquidity on a quarterly basis. Important to note, investors can redeem their position in full on a quarterly basis with pre-notice, etc., if nobody else wants to get out at the same time and if that investor holds less than 5% of the NAV of the fund. There is a soft lockup feature for new share classes that we have to launch, but for the share class that Aktia clients would come in, that soft lockup feature has already expired. It's a Luxembourg domiciled CCAF, and again, we offer monthly subscriptions and quarterly liquidity with a 90-day pre-notice. As far as fees are concerned, we only charge management fee on what I call productive capital. So the fair market value of the underlying portfolio plus the open commitments that the fund has reserved relative to the underlying portfolio. As of August, that was the 87 million euros that I had shown you on the slide earlier. If you're wondering what happens to the difference between the 142 million euros and the 87 million euros, well, that is cash that is sitting there waiting to be invested, and we have a full pipeline that will take care of that by the end of September, if all goes well. But until that capital is at work for investors, we do not charge management fees on that. And that's, I think, an important differentiation to how other people in the industry are doing it. And then we have a 10% performance fee, 10% of gains over an 8% preferred return with a high watermark feature and a liquidity test. And I think if you compare these terms again to other solutions in the market out there that we are competing with, you will find that they're actually quite investor friendly. Do we have any other questions so far from the audience?
There's one question regarding the focus on small and mid-cap segment. So could you elaborate what you mean by that, and also why you think it's beneficial to focus on that vis-a-vis the larger deals? You touched upon it a little bit, but maybe you can elaborate, please.
Yeah. Let's maybe look at a case study or two, just to give people a little bit of a flavor.
Thank you. Do that.
So here is one transaction that is part of this portfolio called Project Neptune. The situation here was one of the fund managers that we have invested with, a group out of Switzerland, had a company in an older fund that they tried to sell, but given the environment, they just did not get the valuation that they wanted. They had owned the company for 5 years, had grown it from something very small to something substantially larger. It's a logistics business headquartered in Switzerland. And they just said, at this valuation, I don't want to hand over the keys to a new owner who can then benefit from all of the work that we put in. So they approached the secondary market to raise a fund and generate a new entity, new capital pool that would support the company for another 5 years, together with management, together with investors. They've set up this entity, and so far the portfolio is performing really well. Now, if you look at how large that company is in terms of enterprise value, in terms of profitability, it's not a big company at all. Like, the enterprise value is below 500 million Swiss francs. That's the type of exposure you simply will not be able to access in the public market. Why do we like it? Well, first of all, there's a demonstrated history of growth that has been implemented by the current management team together with this fund manager. Once the company reaches a certain size, it will be attractive to a multitude of buyers. And we think, this fact pattern really lends itself well to delivering outperformance from this type of strategy. Anything else from the
yes,
audience?
there is one which I don't know if you want to respond or not. We'll see. But it's a question regarding sort of underlying private equity managers.
Right.
So could you give a little flavor of who you are partnering with, what type of private equity managers is it, etc.?
So I'm a little bit reluctant to disclose names. Some of the fund managers don't like that in a public forum. What I can say is that we have a preference to work with fund managers that are part of the platform already. I mean, UBS Asset Management has been investing in private equity since 2000. We manage a portfolio with roughly 5 billion in assets under management. So there is good connectivity with the ecosystem. Think of names that are the who is who of private equity. They would be part of this portfolio. They are part of this portfolio at this point in time.
Thank you.
How about if you look at the secondary investing? Obviously, like you showed these examples, maybe the biggest driver of performance obviously is to find good assets that perform, but then you kind of have the optionality of the discount premia if you can buy cheaper than the actual NAV, which is published later. What do you see like the biggest driver of performance? Quality assets or getting discounts, or kind of a combination of these?
So the nature of this product, the nature of this strategy is to focus on quality assets. Yeah, I don't mind paying up for quality assets because I can sleep better at night and don't have to worry that anything goes wrong. At the moment, though, we are in an environment where I can have it both ways. I can buy very good funds. I can buy into very good companies at very, attractive entry prices that typically come at discounts to net asset value. So at the moment, I get the benefit of both.
Yeah, it's interesting. How about if we dip into a bit on the kind of cross-asset perspective? I mean, most people in the audience have investments in liquid asset classes, let's say equities, fixed income. Some even have global diversification in their portfolios. How do you approach if you want to add alternatives or non-listed market segments to your liquid holdings? How would you, Jochen? I mean, you love this asset class, but how would you, let's say, compared to other alternative asset classes, how much would you put into this segment?
I'm obviously biased, and this is not an investment recommendation, to be very clear. Yeah, but in my own personal balance sheet, I would go up to 25% private equity secondaries.
Wow. Yeah.
The reason is, the exposure you get from this asset class, I mean, it's a good complement to what you have on the public equity markets, right? It's also the most liquid sub-asset class within private markets, within private equity. And I like the diversification, and I like the ability to get assets like these at discounts to net asset values. Yeah.
And compared, let's say, the alternative was regular private equity, would that be a lower percentage? So is it the secondary thing that's kind of intriguing to you?
So me being the secondaries guy, I would not do anything else but secondaries. Yeah. But I mean, all joking aside, what we have seen from clients, from pension fund clients, is an allocation of up to 20% in private equity. And within that allocation, secondaries used to be underweight. I think that is changing now to a point where secondaries can be 25, 35% of a private equity allocation. But I mean, if you're just starting out within private equity, right? If you're starting out in any asset class, I think what you need to be mindful of is get enough diversification and try to keep the costs low. And I think that product does exactly that. So if you're just starting out in private equity, I think this is a perfect starting point, and then you build from there.
Yeah, and maybe the market opportunity gives some tailwind currently because of the dynamics.
Maybe I can add to that, and Jochen, you mentioned that 20% of pension funds or foundations have been in private equity in the past. What we see also as UBS, we also have our own private bank, and also we see among other peers in the market that individuals in the past, private individuals, did not have 20% of private markets in their portfolios. It has rather been 2, 3, 4, 5%. Now, what we try to achieve with this product and also is the access to an asset class in an easy way, in a format that works for private individuals, in order to increase that level so that it gets closer to potentially a professional investor was investing their money, and they've been doing so for 10, 20, 30 years in the past. So this is sort of where we also see our product here playing an important role in increasing that allocation.
Yeah. Okay, great. There was actually a question popped up about the fund. Yeah, UBS Secondary is a relatively recent fund. Can you elaborate more on UBS track record on the private equity and secondaries segment?
So as an organization, we've been investing in private equity since the early 2000s. We've opportunistically played on the secondary side of things, but we really focused on it and reinforced it in 2018. So since then, as of June, we've completed, and the track record comprises about 40 transactions with an average multiple of 155 and a gross IRR of 19%. So there's, good history there. If you look under the hood, so to speak, we are particularly proud that, at least so far, we have not lost capital on any of the transactions that we did. And, we will implement that same strategy with this product. This is the first and so far the only dedicated secondaries-focused product. We manage a suite of primary-focused fund of funds, where we are now in the 5th generation. Since Fund 3 in that fund series, we've added secondaries to the portfolios.
Another question that is coming in, we talk a little bit about, could you talk about the team and where are you based? Which are the most important parts to be present in geographically?
Yeah. So the people that you see here on this slide are the investment team. So there's 18 of us sitting in 5 offices around the globe. I sit in San Francisco. We have colleagues in New York, London, Singapore, Zurich. And we are being supported by the whole UBS armada and army of aligned functions that make sure that the fund is being run, or our funds are being run properly. What's important to note about our investment team and our investment approach, that everybody that you see on this slide contributes to the investment process and contributes to the secondary investing. So everybody here on this slide has contributed to the investment activities of this fund, so you're not simply relying on myself.
Yeah. Maybe one, there are secondary managers because of the opportunity. It's getting more popular. Fortunately, we're on the early stage offering this opportunity. It's also fashionable for private equity houses to do this in-house, like feeders to their own products. Right. How do you feel this kind of open architecture is, different or differs from that?
Look, the fundamental difference between this product and a product where, one of the large private equity houses is feeding their own funds, so to speak, and putting their own deals in, is that this is a multi-manager approach. Yeah. You're not beholden to the fortune of just one investment house. You have, like I mentioned earlier, 19 deals underlying, 16 fund managers, where you get additional diversification and additional skill set also that may not be available with only a single fund manager that you're backing.
Yeah, makes sense. Okay, I mean we're a bit ahead of schedule, but let's see. At least I don't have any more questions here. How about you have, Eric, any ideas or something you like to squeeze in before we end?
Not for the sake of it, but I would be curious to understand sort of if you have any darlings in the portfolios, any more sort of something, a favorite that you can point out or an investment that you made potentially, except for what you mentioned.
The one that I had mentioned earlier certainly is a darling of mine.
If you can choose among your... I mean, you have many darlings in the portfolio.
Yes. Another one that I really like is this transaction here. It's with a fund manager that we have invested with for a very long time. They had 3 companies in the insurance distribution wealth management space, one in the UK, one in the US, one in Canada, that they wanted to continue to support. And because we've known that team for such a long time, really liked what they have done in the financial services space, in particular in this space. We had also participated in another investment with them that has done really well for us. We thought this was an opportunity that would be a great fit for the strategy and a great fit for the portfolio. Given the environment, that transaction was structured, again, at a discount to the net asset value of the assets that was being sold. There was very strong alignment of interest with the manager, who offered to stay fully invested, offered incremental personal investment, offered additional investment from the new funds that they were currently managing, and so far the transaction is off to a great start, and we think there is further upside left in the assets that we have bought. Yeah.
Thank you.
Interesting. Okay, well, I mean, thank you very much, Eric and Johan, and maybe I'll finish with a few words in Finnish.
As long as they are fair.
They're fair and objective, of course. Mutta joo, kiitos kaikille paljon osallistumisesta ja toivottavasti jäi ajatuksia mieleen. Ehkä yhteenvetona voisi todeta, että jos miettii sijoittamista alternatiiveihin ja varsinkin jos puhutaan private equity-sijoituksista, niin usein osakesijoittamista lähestytään niin kuin markkina-arvojen kautta. Mikä on isoin markkina, minne laitetaan rahaa, niin private equity on alternatiivipuolella varmaan isoin laji maailmassa. Ja tämä secondary-rakenne tai se mahdollisuus, mitä markkina nyt tuo, niin se avaa oikein hyvän tavan niin kuin päästä helpolla mukaan keskeiseen niin kuin alternatiivilajiin, joka sitten hajauttaa näitä likvidien sijoituksia ja toivottavasti parantaa niin kuin oman salkun tuottoriskiprofiilia. Mutta jos tästä haluaa kuulla lisää yksityiskohtia tai mitä tahansa tuotteeseen liittyvää, niin olkaa ehdottomasti yhteydessä meihin oman yhteyshenkilön kautta. Eli kiitos paljon kaikille ja thank you a lot, Erik and Johan, and we are available for any additional questions. Thank you.
Thank you very much.
Thank you, Samu.
Thank you.